Alphabet reported quarterly financial results that are sending the stock price down by more than 7% in the aftermarket hours following the company's earnings release. Of course, I'm disappointed in that. I've recommended Alphabet as one of the top stocks to buy right now in 2025. But do I still think the company is a buy? Do I think this dip is a buying opportunity? I'll answer that question in this video. I'll also review the company's financial results and highlight the big picture items, the things that are beyond the obvious, the revenue and earnings per share that are obviously reported by every media outlet. I'm going to look into the details and what it could all mean for investors before I update the recommendation to buy, hold, or sell on this dip. Of course, I'll also touch on my valuation metrics for Alphabet stock as well. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right, so one of the things I'm paying close attention to with Alphabet is the search business and how it's evolving, because one of the biggest risks right now is how large language models like ChatGPT could impact Google Search's business dominance. And in the most recent quarter, I saw another strong quarter for search, and management even said that in their search business, advances like AI overviews and circle to search are increasing user engagement. That's great to hear that user engagement is increasing in this critical segment for Alphabet. And another number myself and I think very many investors were looking to is Google's capital expenditure number, or Alphabet's capital expenditure number. Given all of the investments that are going into artificial intelligence, this number is something that's widely watched right now. And Alphabet said that they're confident in the opportunities ahead. And to accelerate their progress, they're forecasting they will spend $75 billion on capital expenditures in 2025. And to give you a comparison, Microsoft said it was going to spend $80 billion in capital expenditure in 2025. Meta Platforms said they were going to spend 60 to 65 billion in capital expenditures in 2025. So Alphabet's numbers are comparable to those other large cap tech stocks that have already reported earnings. Of course, I haven't yet evaluated Amazon's earnings, and their investments in capital expenditure will also be interesting to evaluate, to be sure. But this number and all of these numbers that have come out are great news for NVIDIA stock investors. Remember about a week and a half ago when NVIDIA's stock price crashed by 17% because of the developments from China's DeepSeek and how that could impact the spending from these large tech companies? And so far, these large cap tech companies that are NVIDIA's biggest customers, they've increased their budgets significantly for 2025. So far, so good in that regard. Alphabet saying that the revenue increased by 12% year over year to $96.47 billion. And for the full year, revenue increased by 14% to $350 billion. I always find it remarkable that Alphabet generated $350 billion in revenue by offering mostly free products. I find it really impressive they're able to do that. They deliver great customer value because free is a great customer value for YouTube, for Google Search, for its Google Suite, and they're able to generate over $350 billion in revenue. That's truly impressive. And they do that while also generating a operating profit margin of 32%, or in other words, they generated over $112 billion in operating income. I like to sit back and think about that for a minute. They offer free products and they generated over $112 billion in profit from offering free products. That's truly remarkable. That's an amazing business model. That's just so lucrative. And it's part of the reason why I've had Alphabet stock rated so highly. It was my top stock to buy in 2024. It got a little bit of a downgrade for me for 2025 just because the price had increased by so much in 2024 and because I liked at least one other business better than Alphabet in 2025. but still the business performance remains incredible. Operating margins increased. The revenue growth rate decreased slightly in the latest quarter to 12%, but for the full year, it was still up by 14%. So Google search, again, a segment that I'm watching very closely with Google because of the risk from large language models. In the most recent quarter, revenue increased in this segment by over $6 billion to 54 billion, up from 48 billion. So that was a roughly 12% rate of increase for Google search. That's very solid despite all of those risks from large language models. Despite all of the popularity of large language models, Google search continues to dominate this consumer segment. I was also impressed with its ability to keep costs under control, only adding less than 1,000 employees year over year, while overall revenue increased by 13 billion year over year. They did that with only 1,000 more employees, so I was pleased to see that. All right, with all of this spending on capital expenditure, I'm actually a fan of this for Alphabet to spend money on capital expenditure and less money on employees. Their total cash balance as of December 31st last year, they had $111 billion. And this is, cash that's just sitting around earning the minimum balance, like 5% rate of return or whatever the treasury yield will give you. And I've felt that Alphabet can have better uses for that capital. And so I like that they now have, instead of $134 billion of property and equipment, they have $171 billion of property and equipment. And it's reasonable to assume that Alphabet's property and equipment, these are data centers optimized for AI and things like that. It's reasonable to assume that these assets will generate a greater return than a 5% government bond, which is what they had their money in mostly previously. So they reduced that balance from 111 billion to 96 billion. And then the cash flow they generated from the business, they also allocated. And so I like to see them spending more money on CapEx, an area they've been very good at finding opportunities. And the business certainly generates enough cash flow to justify that spending. In the fiscal year that just ended, December 31st, 2024, Alphabet generated $125 billion in cash flow from operations, $125 billion. So it's from this balance that they can spend on capital expenditures, which last year they spent $52 billion on capital expenditures, purchases of property and equipment. This is the number that they highlighted. They're going to increase to 75 billion for 2025, or a roughly 50% increase from their 2024, which was also a big increase from 2023. And they're not going to continue increasing it by this magnitude. They're only going to do it so long as they see this opportunity. And when they feel like they've gotten at a level they feel comfortable with to match the consumer demand for artificial intelligence, they'll slow down these capital expenditures. But for one, I'm hoping for them to continue, because that means that they see it as a great opportunity. And so they keep spending on that. I'd rather have them spend money on property and equipment than put that money in a government bond. Of course, they can also return that capital to shareholders, which I would also prefer more so than Alphabet leaving it in government bonds and keeping it on its balance sheet. That's by far, well, not by far, but that's one of the worst things, in my opinion, that Alphabet can do with this capital, is to just leave it in government bonds. I'd rather see them deploy that capital either in property and equipment, in capital expenditures, or returning it to shareholders in the form of dividends or buyback. All right, so Alphabet's now trading at a forward price to earnings of 20, which I still think is really. And when I did my discounted cash flow valuation, I found Alphabet stock to be worth $238 a share. Its current market price is actually lower than the $206 I see here. The current market price is actually $190 because of the aftermarket action. It's down 8% now, over 8% following these developments. And as I went through their earnings results, the downside, the only downsides that I saw is that huge increase in capital. The downside I'm talking about from the investor perspective is the huge increase in capital expenditures, a 50% increase, which I understand it spooks a lot of investors. Um, and then also the slowing growth rate in certain segments. And then, of course, the expectations that were built in, certain expectations for Google Cloud, which the company missed, certain expectations for revenue, which the company missed. And those tend to send the stock price down. But these are reasons that I like to buy. And so, to answer the question, is this a buying opportunity? I say yes. And so I already updated, following my review of Alphabet's earnings, I updated my recommendation, reiterating that I still think Alphabet is a top 9 stock to buy following this dip. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.